$51,000 vanished in 90 days. That's not a company bankruptcy. That's not a failed hedge fund. That is the dollar value evaporated from every single Bitcoin between the November peak at $126,000. And here's what should terrify you. According to Polymarket prediction markets, 72% of traders believe Bitcoin will drop below $65,000 before 2026 ends. That means the majority expects another 10,000 plusers drop from current levels. Welcome to the Wealth Continuum. I'm about to show you why this Bitcoin bear market is fundamentally different from 2018 and 2022, and why that difference could determine whether you're buying opportunity or catching a falling knife. Comment below if you're moving money this week, because what I'm about to reveal about volatility compression, market forward pricing, and the deflationary narrative will completely change how you view this drawdown. This isn't your typical crypto crash analysis. This is about understanding market structure evolution and what happens when an 80 volatility asset becomes a 40 volatility asset virtually overnight. Let me show you the numbers that Wall Street doesn't want retail investors to understand. Bitcoin peaked at $126,000 on November 20th, 2024, exactly as the Trump administration's pro-crypto stance became clear and tariff policies started dominating headlines. That peak represented an 80% rally from the $70,000 level Bitcoin traded at on election day. Then came the cascade. By January, we were at $108,000, then $105,000. Then we broke the psychological $100,000 barrier on January 28th, the first time Bitcoin had traded below six figures since initially crossing that threshold. And finally, we hit $75,000 on February 1st, 2026. That's a $51,000 decline. To put that in perspective, a 40.5% drawdown from peak to trough, $618 billion in market cap, destroyed equivalent to the entire GDP of Sweden vanishing in 3 months. Now, here's where it gets interesting. And this is the data point that should make you pay attention regardless of whether you own Bitcoin or not. This drawdown matches almost perfectly with historical volatility compression patterns. Bitcoin's realized volatility, the actual price movement we can measure, has declined from approximately 80% annualized in 2020-2021. Hit like if you're seeing where this math leads. Because when you understand this volatility compression, everything about this bear market suddenly makes sense. In the 2018 bear market, Bitcoin dropped from $19,800 to $3,200, an 84% decline. In the 2022 bear market, Bitcoin fell from $69,000 to $15,500, a 77% decline, both roughly aligned with 80% volatility characteristics. But if Bitcoin now trades with 40% volatility, half the previous level, then you should expect drawdowns of approximately 40%, not 80%. We're at 40.5% right now. The math isn't predicting capitulation to $30,000. It's suggesting we might be at or near the structural bottom for this cycle. But here's what they're not telling you. The reason volatility compressed isn't random. It's the direct result of Bitcoin financialization. And understanding this changes everything about what happens next. Let me explain what happened to Bitcoin between 2021 and 2025 that fundamentally altered its market structure. Stage 1, corporate treasury adoption, 2020-2022. MicroStrategy, led by Michael Saylor, initiated the corporate treasury movement in August 2020 by purchasing $250 million in Bitcoin. As of February 2026, MicroStrategy holds approximately 528,000 BTC, worth $39.6 billion at current prices. This wasn't speculation. This was balance sheet allocation by a publicly traded company subject to SEC reporting requirements, audited financials, and institutional oversight. Other companies followed: Tesla, Block, formerly Square, Marathon Digital, and dozens more. Stage 2, ETF approval, January 2024. The approval of spot Bitcoin ETFs by the SEC on January 10, 2024, marked the single most significant structural change in Bitcoin's history within the first year. BlackRock's iShares. Bitcoin Trust, IBIT, accumulated over 650,000 BTC Fidelity's FBTC, holds approximately 485,000 BTC combined spot. ETF holdings exceed 1.2 million BTC, $90+ billion AUM. Daily trading volume regularly exceeds $3 billion. These aren't degenerate crypto traders. These are 401ks, pension funds, RIAs managing family wealth, and institutional allocators following modern portfolio theory. Stage 3, derivatives. Sophistication, 2024-2025. This is the stage most retail investors don't understand, and it's the most critical for explaining current price action. Asset managers launched covered call ETF strategies. tickers like YBTC, BTCW, that systematically sell call options against Bitcoin holdings. This creates constant selling pressure on upside while collecting premium. CME Bitcoin futures open interest hit 15.8 billion in late 2024. Options on Bitcoin futures exceeded 2.4 billion in open interest. Market makers hedging these options execute sophisticated delta hedging strategies that dampen volatility in both directions. What does this mean in practice? When Bitcoin starts rallying aggressively, market makers who sold call options need to hedge by selling Bitcoin futures, which caps the rally. When Bitcoin starts falling, market makers covering put hedges need to buy, which cushions the decline. The result, volatility compression. The explosive 100% plus monthly moves of 2017 and 2020 become mathematically improbable when you have 18 plus billion in derivatives systematically dampening price swings. This is where it gets really concerning. Because if you're using historical bear market playbooks expecting 80% crashes, you're fighting the last war with outdated tactics. The market structure has fundamentally changed, and that changes optimal strategy. Now let's address the elephant in the room, the Bitcoin halving cycle and why it still matters, just not in the way most people think. The Bitcoin halving, where mining rewards get cut in half roughly every 4 years, creates a supply shock. Simple economics says that if demand remains constant and supply decreases, prices should rise. This is played out 3 times. 2012 halving, 2013 bull market, peak November 2013, 2016 halving, 2017 bull market, peak December 2017, 2020 halving, 2021 bull market, peak November 2021. The most recent halving occurred in April 2024, and we did see a subsequent bull market with Bitcoin peaking at $126,000 in November 2024. The cycle pattern held. But here's the crucial distinction. The cycle can remain valid while the amplitude of moves changes dramatically. Let me show you what I mean with data. 2017 cycle, bottom, $150, January 2015, peak, 19,800, December 2017, return, 12th, 921%, subsequent drawdown, 84% on 2021. Cycle, bottom, 3,200, December 2018, peak, 69,000, November 21, return, 256%. Subsequent drawdown, 77% 2024 cycle. Bottom, $15,500, November 2022, peak, $126,000, November 2024. Return, 713%, current drawdown, 40.5%. Notice the pattern? Each cycle produces lower percentage gains and lower percentage drawdowns. This isn't the cycle breaking, it's the cycle maturing. As Bitcoin's market cap grows from 3 billion outer 2015 to 30 billion 2018 to 300 billion 2021 to 1.5 trillion 2024, the same dollar inflows produce smaller percentage moves. A $10 billion inflow into a $30 billion market cap is massive. Into a $1.5 trillion market cap, it's 0.67%. The halving creates a supply shock, but the impact moderate says the absolute number of new coins decreases, 6.25 BTC per block, 3.125 BTC. The proportion of new supply versus existing supply shrinks. Market cap grows, requiring larger capital to move percentages. Stay with me, because the next part is crucial. Understanding this maturation cycle is what separates investors who buy bottoms from those who panic sell them. Now we get to the real reason Bitcoin crashed from $126,000, and it's not what most people think. Markets are forward-looking mechanisms. They don't price in what's happening today. They price in what's expected 6 or 12 months from now. Let me prove this with recent history. The 2020-2021 inflation trade. In March 2020, in response to COVID, the Federal Reserve cut rates to zero and launched $4 trillion in quantitative easing. The U.S. government passed $5 trillion in fiscal stimulus. Basic economics suggested this would cause inflation. Smart investors, Paul Tudor Jones, Stanley Druckenmiller, Ray Dalio, didn't wait for inflation to show up in CPI prints. They bought inflation hedges immediately. Bitcoin rallied from $10,000 October 2020 to $60,000 April 2021. Gold rallied from $1,700 to $2,070. Commodities indices surged. Then actual CPI inflation appeared in mid-2021, eventually peaking at 9.1% in June 2022. But by then, Bitcoin had already made its move. The market priced in inflation before it arrived. The 2024-2025 deflation. Repricing. Fast forward to late 2024. Trump wins the election on a platform that includes universal tariffs, 10-20% on all imports, 60% on China, aggressive deportation of undocumented workers, drill baby, drill energy policy. The market's immediate reaction, tariffs, versus higher prices, reduced inflation, produced by Bitcoin. Bitcoin rallied from $70,000 election day to $126,000 November peak in a matter of weeks. The market was pricing an expected tariff-driven inflation. But then economic analysts started doing the actual math, tariff impact analysis, 10% universal tariff on $3.1 trillion in imports, $310 billion in tariff revenue. But tariffs reduce import volumes by 15-25% as prices rise and demand falls. Net effect, $260 billion in revenue, $200 billion in higher consumer prices, one time. This is not sustained inflation. It's a one-time price level increase. Deportation impact. Removing 1.2 million workers creates wage pressure in specific sectors, but it also reduces aggregate demand for housing, goods, services. Net effect. Localized wage inflation offset by demand destruction. Not economy-wide sustained inflation energy policy. Increased drilling permits would take 12-18 months to impact production. Global oil markets set prices, not domestic policy. Net effect, marginal downward pressure on energy costs. By December 2024, sophisticated institutional traders realized, wait, this isn't going to cause sustained inflation. This might actually be deflationary. Here's why deflation became the base case. Demand destruction. Tariffs make imports more expensive, consumers buy less, economic slowdown, business. Uncertainty. Companies delay investment amid policy uncertainty. Slower growth, consumer confidence, real wages pressured by tariff costs, reduced spending. Global slowdown, trade wars reduce global trade volumes, worldwide deflation pressure. In a deflationary environment, what performs well? Productive assets that can operate efficiently despite price declines. Cash and government bonds, deflation increases real value. Assets with pricing power and technological advantages. What underperforms? Inflation hedges, gold, commodities, Bitcoin, non-productive stores of value, highly leveraged assets. You need to understand this before I show you what's next. Because this repricing from inflation expectations to deflation expectations explains the entire $51,000 crash. And it suggests we're at or near a bottom, not starting a collapse. Now let's address what's confusing everyone. If we're facing deflation rather than inflation, why is gold at all-time highs above $2,250 while Bitcoin crashed 40%? The answer reveals something profound about how different buyers perceive different assets. Gold, the central bank bid. According to the World Gold Council, central banks purchased 1,037 tons of gold in 2023 and another 1,045 tons in 2024, the highest two-year period since 1950. As of Q4 2024, People's Bank of China holds 2,264 tons, up from 1,948 tons in 2020. Reserve Bank of India holds 854 tons, up from 676 tons in 2020. Central Bank of Poland holds 359 tons, up from 229 tons in 2020. This isn't inflation hedging, this is defiatization, moving away from fiat currency dependence entirely. Historically, when central banks wanted to reduce dollar exposure, they'd sell dollars and buy euros, yen, or yuan, switching from one fiat to another. But since 2020, we're seeing something different, selling dollars and treasuries to buy gold. Why? Because central banks view gold as sovereignty neutral, no counterparty risk, no political ties, infinite liquidity, $13 trillion market cap accepted globally, 7,000-year track record, ultimate Lindy effect geopolitical hedge. If SWIFT gets weaponized, gold still works. This is a structural bid unrelated to inflation expectations. China buying 300 plus tons annually doesn't care if US CPI is 2% or 4%. They're executing a multi-decade strategy to reduce dollar dependence. Bitcoin, the retail and institutional speculation. Now contrast that with Bitcoin buyers. Retail investors buying inflation hedge, institutional allocators adding 1 to 3% portfolio exposure. Corporate treasuries, MicroStrategics, converting cash to Bitcoin ETF investors getting crypto exposure. Notice what's missing. Central banks. According to industry surveys, fewer than 5 central banks globally hold any Bitcoin. The few that do, El Salvador, hold minimal amounts relative to Forex reserves. Why don't central banks buy Bitcoin? Volatility, 40% annualized VOL is unacceptable for reserve management operating history. Only 16 years versus gold's millennia political sensitivity. Bitcoin viewed as competitor to monetary sovereignty, regulatory uncertainty, unclear legal status in many jurisdictions. Size limitations, 1.5 T, market cap can't absorb major central bank buying. So when inflation expectations fade, Bitcoin loses its primary demand driver, inflation hedge buying, while gold maintains its structural central bank bid. This explains the divergence perfectly. Gold rises on defiatization demand. Bitcoin falls on reduced inflation hedge demand. Different buyers, different motivations, different outcomes. Bitcoin just fell from $126,000 down to $75,000. That's a 40% drawdown, and right now one of the biggest questions in the entire market is simple. Are we entering a bear market, or is this just another normal bull market correction? Because if you've been around Bitcoin long enough, you know volatility is part of the deal. We've seen 30% drawdowns multiple times, even in strong bull markets. And many people are arguing that this is just another shakeout before Bitcoin continues higher toward 150K, 200K, maybe even beyond. But I don't agree with that framing. I think Bitcoin is in a bear market right now, but it may be a very different kind of bear market than what people remember from past cycles. A huge part of the confusion comes from the 4-year cycle narrative. The idea that the halving creates a supply shock, prices surge, then eventually we get these brutal 70 to 80% collapses, and then the process repeats. And I do think the halving matters. If supply issuance gets cut and demand stays steady, higher prices are the logical outcome. But what's changing is the severity of the cycle. Bitcoin is no longer trading like the same asset it was in 2017 or 2020. Volatility is compressing. Bitcoin used to behave like an 80 volatility asset, but today it trades closer to 40 volatility, which is essentially a 50% reduction. And if volatility is being cut in half, then it's reasonable to expect that the upside becomes more muted, but also that the downside becomes less catastrophic. Instead of 80% drawdowns, we may be entering an era where 35 to 45% drawdowns are the new bear market structure. And that's exactly what we've just experienced, from 126K down to 75K. Now, the deeper reason Bitcoin is falling isn't that it suddenly stopped working. It's that markets are forward-looking. Go back to 2020 and 2021. Investors expected inflation because of undisciplined fiscal spending, stimulus, and monetary expansion. So they bought Bitcoin and gold before inflation even arrived. Bitcoin ran from 10K to 60K before CPI ever peaked, because markets price the future, not the present. Fast forward to 2025. Bitcoin was around 70K when the Trump administration got elected, and it surged to 126K because markets began pricing in tariffs, inflation risk, and a more Bitcoin-friendly regulatory environment. Bitcoin was repriced aggressively higher, but then it peaked, and it started to come down because the market began pricing a different risk, not inflation, deflation. The market is realizing that inflation may not be the problem for the next couple of years. Instead, slowing growth and deflationary pressure could be the real macro threat. And in a deflationary environment, the demand for inflation hedges weakens. Store of value trades lose momentum, and investors rotate toward productive assets and liquidity. So Bitcoin didn't fail. Bitcoin actually worked in the inflation repricing phase. The problem is that the market is now repricing away from that inflation narrative. Now, another major narrative circulating right now is this idea that falling hash rate signals minor capitulation. The data is technically correct. Bitcoin hash rate dropped from around 775 exahashes per second in mid-January to about 685 exahashes per second in late January, roughly a 12% decline. But context matters enormously. In late January 2026, an Arctic blast hit North America. Temperatures dropped 20 to 30 degrees below normal across Texas, Oklahoma, Kansas, and much of the Midwest. Natural gas demand for heating spiked, grid stress increased dramatically, and miners in these regions faced a simple economic decision. Option A was to keep mining Bitcoin. At current difficulty, miners earn roughly 0.12 BTC per day per EHS, which at $75,000 per Bitcoin is about $9,000 per day per EHS, while paying electricity costs around 5 to 8 cents per kilowatt hour. Option B was to curtail mining and sell power back to the grid through demand response programs. Those payments were running around $1,900 to $4,000 per megawatt hour, which works out to an effective $12,000 to $15,000 per day per EHS equivalent. So when grid payments exceed mining revenue by 30 to 50%, rational miners shut down temporarily because it's simply more profitable. Major miners publicly confirmed this. Riot platforms curtailed nearly all operations during peak stress. Marathon reduced output by about 80% for multiple days. Cipher mining shut down most Texas facilities for almost a week. And then, as temperatures normalized, hash rate rebounded quickly back toward 735 EHS. This was not capitulation. This was grid participation and revenue optimization. In long term, it's actually bullish because it shows miners can provide flexibility, build political capital, and operate a sophisticated energy infrastructure. So where does Bitcoin go from here? Based on volatility compression, forward-looking markets, financialization, and the macro repricing we're seeing, there are three realistic scenarios over the next 6 to 12 months. The first scenario is the volatility-bounded bottom. In this case, the 40% drawdown we've already seen is essentially the new bear market normal in a 40 volatility environment. Bitcoin trades between 72K and 88Ks for several months. Dips near 70K get bought aggressively, accumulation continues, and by late 2026, Bitcoin gradually trends back above 100K. The next cycle peak might be closer to 180K to 220K, not the explosive 300K plus. That's targets people throw around. The second scenario is a deflation grind lower. If deflationary pressure intensifies, growth slows, unemployment rises, and risk appetite fades, Bitcoin could grind from 75 KLs down towards 65 KLs over the next few months. It could test the 60K to 62K region, possibly wick toward 55K during capitulation events, and then stabilize in a wide range until inflation fears return in 2027. The third scenario is the black swan contagion risk. This is the tail event that could produce a deeper crash, similar to 2022. It would require forced selling, not just normal market dynamics. A highly leveraged corporate treasury company breaching debt covenants, dumping tens of thousands of BTC into an illiquid market, triggering margin cascades. But here's the key distinction. The leverage structure today is not what it was in 2022. Back then, Bitcoin was rehypothecated through yield platforms like Celsius, BlockFi, Voyager, and Alameda, where one BTC deposit supported multiple layers of lending exposure. When Luna collapsed, the entire chain unwound violently. Today, most of the largest debt structures are long-dated, transparent, and not subject to margin call liquidation. MicroStrategy maturities are 2027 through 2029. Marathon loans are secured by mining equipment, not Bitcoin. Riot has similar long-term convertible structures. So scenario 3 is possible, but it requires a very specific catalyst, and it's less likely without one. Now, one of the most fascinating sentiment indicators right now is Polymarket. The odds of Bitcoin trading below $65,000 in 2026 are currently around 72%. That's extreme bearish consensus, and that can actually become a contrarian bullish signal, because when everyone agrees on downside, it becomes fully priced in. If Bitcoin does not break below 65K, the surprise is upward, positioning unwinds, and the market can turn faster than people expect. So the real takeaway here is that this is not a bear market like 2018 or 2022. This is a volatility compressed maturation drawdown in an asset transitioning into institutional financial infrastructure. The question isn't whether Bitcoin survives. It will. The question is whether you have a framework, whether you're accumulating systematically, sizing correctly, and positioning to benefit when the cycle eventually turns. Comment below, are you buying this dip, holding through it, or sitting in cash? And if you want the follow-up breakdown tracking which scenario is unfolding in real time, make sure you subscribe, because the next few months will define Bitcoin's next major phase.